Today, we're diving into a real economic mystery. You see, the job market is flashing these classic, bright red recession warnings. But at the same time, other key parts of the economy look stronger than ever. So, what on earth is actually going on? Let's investigate.
All right, let's just get right to it. This is the question that's on everybody's mind, right? You see the headlines about layoffs, you feel the pinch at prices at the store, and you just can't help but wonder, are we already in a recession? Well, let's look at the evidence.
So, the first and honestly the most alarming clue is this number. The national unemployment rate has jumped by zero point 0.9 percentage points. Now, I know what you're thinking. That doesn't sound like a lot, but here's the kicker. If you look at the data all the way back to the 1960s, a jump this big has always signaled a recession was happening. Every single time. That's a huge red flag.
And listen, this isn't just a US problem. We're seeing a really similar story play out all over the world. You look at Canada, Germany, the UK, unemployment is ticking up there too. And that usually suggests there's a bigger systemic thing going on, which only strengthens the case for a downturn. So, with such a clear-cut signal from the job market, you'd think, case closed, right? We're in a recession. But not so fast, because it turns out the official call isn't based on just one number. That decision actually rests with a small committee of economists at the National Bureau of Economic Research, the NBER, and they have a very specific playbook they follow. So the NBER defines a recession as a significant decline in economic activity. And as you can see, in their own words, unemployment is a huge determining factor. So the case for a recession seems pretty solid, doesn't it? Well, here's the twist. There are three other major things they look at. The NBR is basically looking at a dashboard with four main gauges. Yeah, unemployment is number one, but they also watch industrial production, real personal income, that's after you account for inflation, and the total volume of sales. And this, my friends, is where our investigation takes a very interesting turn. And here it is. This is the central puzzle in one simple chart. On the left side, you've got that classic recession signal we've been talking about, rising unemployment. But on the right, the other three official metrics we just mentioned, income, sales, and production, they're all pointing in the complete opposite direction. They're pointing towards growth. Let's break down that good news for a second. I mean, think about this. Despite the weakness in the job market, Americans' real personal income is still going up. The volume of sales has actually started to pick up steam recently. And industrial production, well, it hasn't been booming, but, and this is critical, it hasn't been shrinking, which is exactly what you'd expect to see in a recession. In fact, these three things are all hovering near their all-time highs. And then you've got the big one, gross domestic product, or GDP. The economy as a whole has just kept on growing, chugging along between 2 and 3%. In nearly every single recession we've had in the past, GDP goes negative. So, if this is a recession, it's one of the strangest ones in history, one where the economy is growing and people's incomes are near record highs. Okay, so we've got this major contradiction. The jobs data is screaming recession, while the income and sales data are yelling growth. But what if I told you there's a hidden detail buried inside that scary unemployment number that changes the entire story? Because when you look a little closer, you find something completely unexpected. This is it. This is the hidden clue. While the national unemployment rate is up, the breadth of the problem, how widespread it is actually shrinking. The number of states seeing their unemployment rates go up peaked a little while ago, and now more and more states are actually seeing their job markets get better. This is the exact opposite of what you normally see when a recession is taking hold. And this isn't just some random data quirk. This pattern is a historically powerful signal. Just think about it for a second. During a recession, job losses spread like a virus from state to state. But when the number of infected states starts to go down, it means the fever is breaking. It means the worst is over and a recovery is starting. This exact pattern has marked the end of the last 4 major downturns. So if this pattern almost always signals a recovery is on its way, why do things still feel so weird, so uncertain? What makes this time different? The answer, it turns out, isn't just in the economic data. It's in the very deliberate actions of one powerful institution, the Federal Reserve. And this right here is the crucial difference. In past recessions, it was chaos. Layoffs would spike uncontrollably, forcing the Fed to panic and just slash interest rates to save the economy. But today, The rise in unemployment has been slow and steady. It's been more of a controlled burn, and that's allowed the Fed's response to be equally measured, not a panicked reaction, but a thoughtful adjustment.
You see, the Fed is walking the ultimate tightrope. Rising unemployment tells them, hey, maybe cut interest rates to help the job market. But inflation is still stubbornly above their 2% target, which tells them to keep rates high, maybe even raise them. And all the while, strong GDP and sales numbers are saying, hey, the economy doesn't really need any help. They're juggling completely contradictory signals.
So after weighing all of this conflicting evidence, the good, the bad, and the just plain weird, we can finally get to the single most important takeaway from our entire investigation. Here's the bottom line. This is not your typical boom and bust cycle. The economic slowdown we're seeing, especially in the job market, seems to be an engineered process. It's been deliberately managed by the Federal Reserve in their fight against inflation. And that means everything, absolutely everything, hinges on what they do next. They are the one factor to watch. And that leaves us with the ultimate question. The fate of the economy isn't really being decided by old historical patterns. It's being decided by a handful of people in a room in real time. Are they successfully pulling off that mythical soft landing? Or could one wrong move turn this strange, controlled slowdown into the very recession they've been trying so hard to avoid? The final chapter is still being written.